Just how are higher interest rates screwing you over? Well, sadly, it is the case that bear markets are the gift that keep right on screwing. And well, the first time we all got screwed by inflation, it didn't feel good. Now we're all getting put over the barrel a second time and getting rammed once again by the fallout from the rising interest rates. First, let's talk about how higher interest rates screw over regular people. Now, a big way is that they lead to lower household spending. This is because credit becomes more expensive. People are going to really think twice about racking up any credit card debt when rates are continuing up higher, and they will be much less likely to take on loans versus, their homes, for example, as the rates will be much higher to borrow that money. Also, with property values falling, the wealth effect will be diminished, meaning that people will be more careful with their spending. And that then puts more pressure onto companies already facing issues from inflation, because worsening market and credit conditions will end up leading to decreased consumer spending. That then ends up leading to lower corporate profits. And that then ends up leading to more unemployment coming, which then leads to more slowdown in consumer spending. That's a vicious cycle, man. And just keeps spiraling down the toilet until we hit the bottom, all of which makes a recession more likely. Remember too, that the yield curve is insanely inverted right now, and that when that happens, a recession always follows. Analysts at major banks are still predicting another 25% drop for stocks, keeping in mind that the higher rates are the Fed's way of quote unquote cooling the economy. And it seems to be working, of course, very well for the Fed at the moment. Chilling, in fact. We are seeing the knock-on effects right across the board too. For example, farmers in the USA are facing more trouble as those interest rates keep going up, as if the increases in diesel and the explosion of fertilizer prices didn't hurt farmers enough. Now we have those rates going up and they're hitting farmers just as hard, with many farmers relying on short-term loans for everything from seeds to machines. This means that food costs are more likely to face uncertainty, which could of course then drag out the crisis even longer. But rate hikes, besides being used as a wrecking ball for consumer demand, also have broad-reaching implications for investors. And not just Bitcoin, of course. Yeah, Bitcoin is not so much fun at the moment, is it? But the question for investors becomes, why take the risk at all investing in basically anything when markets could fall further? Why not just flee into bonds? Especially considering that the Federal Reserve is signaling that rates will likely stay high for a while and that they're not finished raising rates. Well, let's start off by talking about stocks, particularly dividend stocks. Why buy dividend stocks that pay 2 or 3% a year when a US Treasury note is around twice that right now after the rate hikes, right? There's virtually no real downside risk to those bonds either, but also no real upside potential, which is the flip side of the coin, of course. Also, keep in mind that a lot of companies could be scaling back on dividend payouts as profits fall, which would likely make the asset price itself go down even further. A lot of risk potential for investors, even with dividend stocks, which are usually seen as a safer area to invest in. Look, I still have and invest in dividend stocks. I'm a big fan of them personally, and long term I think that dividend stocks will far outpace the rates which are in offer right now in this short-term bond bull market. And generally, we see the stock market and high interest rates having an inverse relationship. The higher the interest rates, the more likely it will be to have a negative impact on equities, and vice versa, of course. The fight to bring inflation under control has required a very heavy sacrifice from society, basically. And why did inflation get out of control in the first place? The Federal Reserve overprinted and then handed all that money they printed straight to their mates, who got to front run you on inflation. That diluted your money. That hurt you economically with inflation going out of control. And now their decision to fight this crisis that they caused is once again destroying your wealth. Almost like it's all by design, isn't it? Now, before telling you about the property markets and the crypto markets, I just wanted to let you know about my weekly crypto investor newsletter. It's called Wealth Mastery, and it's jam-packed full of alpha on altcoins, airdrops, NFTs, DeFi tutorials, market analysis, finding ways to make money regardless of the market conditions. Join our 50,000 weekly readers by signing up for free using that link down below in the description. Now, let's talk about the property markets. It is no secret right now that real estate markets are getting hammered. Which leads us to the question, why buy real estate right now when you could buy bonds? So much BS, so much drama, the lawyers, the managing tenants, stuff breaking, all for a similar yield or less than you would get from holding a US Treasury bond right now. Not to mention, of course, the real nail in the coffin for real estate investors is that higher rates mean higher mortgage costs. Unless you are buying real estate with cash right now, you are potentially in for a world of pain with those high interest rates. This is keeping buyers away from the market, which will bring more chaos to the housing market as prices fall to meet demand. That being said, while short-term bond yields may be returning as much as real estate right now, we again have to think about the long-term picture here. The bond bull market will end. Property prices will increase in the future. So long-term, buying property during the slump will provide you with capital gains over 5, 10, 20, 30 years and steady rental income, which is much more likely to outperform bonds over an extended period of time. But now let's talk about crypto. Crypto, right along with tech stocks, which it generally tracks along with, is being basically screwed by this broad risk-off environment that's been defining 2022. When the market starts taking on risk again, I believe that both tech stocks and crypto assets will pump like crazy. But we're a long way from that happening right now. At this stage, it's increasingly likely that unless some insane thing happens to provide some massive bullish catalyst, there won't be any new highs for crypto until 2024 or something. Although we could get some nice rally in 2023, make us all feel good again. But remember that crypto tends to outperform stocks by some magnitude when the bulls do run. That being said, right now, stablecoins are leaving the market. I mean, seriously, why do anything in DeFi with all the risks, the low yields, when you can just park your money in US Treasuries for basically risk-free higher yields? Crypto needs new narratives right now to get that engine started up again, to get people excited about crypto again. Those narratives will come. This is why, in spite of the risks in crypto, I maintain a robust, big crypto portfolio. Okay, that's it. Subscribe now. See you next time.